Hello and welcome to episode 33 of the Special Situations Report, a podcast by Inside Arbitrage covering the most intriguing event-driven activity over the past week. My name is Asif Surya and I'm coming to you from the beautiful San Francisco Bay Area.
And my name is Belinda Surya, and I currently attend the University of California, Los Angeles.
What we will cover on this podcast today is just a small part of what happened in the special situations world last week. For daily updates and alerts on the special situations world, as well as access to tools that help you identify opportunities, such as the merger arbitrage tool, check out insidearbitrage.com.
In today's podcast, we will discuss an even higher bid for Dallas News, multiple rumored deals that came to fruition, including the acquisitions of Tegna, Soho House, Guess, and DayForce. Things heated up in the stock buybacks world as well, with large buybacks announced by Pediatrix Medical Group, insurance company Old Republic, Sprouts Farmers Market, and then the dialysis services company DaVita. We also discuss a fascinating insider purchase of Madrigal Pharmaceuticals by the goats of biotech investing and multiple sudden C-suite departures.
And before we begin, we want to state that nothing on this podcast is meant as investment advice. Please refer to our disclaimer at the end for more detail.
A few episodes ago, we discussed the acquisition of Dallas News by Hearst, which has seen a series of competing bids. What initially started out as a $14 per share offer by Hearst was countered by a $16.50 per share bid by M&G, which motivated Hearst to bump the deal price up to $15 per share.
Yeah, last week we discussed MNG's newest $17.50 per share offer, which was also swiftly rejected by the former CEO Robert Decherd, who is the great grandson of the co-founder of Dallas News, and he indicated that under no circumstances would he vote for or support the MNG proposal.
And that's important because Mr. Deckard owns 96.2% of Class B shares through his family and their foundation. Considering that each Class B shares has 10 votes compared to the Class A common shares, he has 55% of the total voting power, and thus his support is absolutely needed for any deal to materialize.
What's interesting is that MNG doesn't seem to be deterred by this vocal opposition or the poison pill provision adopted by Dallas News that prevents any shareholder from accumulating any more than 10% of the shares outstanding. And it's important to note that MNG currently owns 9.9% of Dallas News stock. Instead, the company came back with an $18.50 offer, putting the ball back in Dallas News' court.
Dallas News currently trades at $14.97, meaning the spread on the existing $15 per share bid is a meager 0.2%, indicating the market's skepticism that any of these competing bids will come to fruition because it isn't trading above $15. It's stuck below that price still.
Yeah, but at this price, it essentially is a free lottery ticket, isn't it? I know this is a tiny deal. The original deal was just $75 million, and at this revised price point, maybe it's close to $100 million, and very few people can probably participate in it in size. But feels like pretty much like a free lottery ticket if you can get in and hold on for a few weeks to see how it all plays out.
Exactly. Either you get 3 cents per share, or you might even get $1 more if the deal is revised upwards once more.
Yes, you're right. Hearst did revise their original deal up by $1, and which means maybe if they want to stick to acquiring the company, they might sweeten the pot just a little bit more. Switching gears a little bit, in one of our earlier episodes on this podcast, we discussed a developing deal in the work situation regarding the International Private Members Club, Soho House. Billionaire Rob Burkle, who also happens to be the chairman of Soho House, had offered to take the company private at a deal valued at $1.7 billion back then.
Shortly after, Dan Loeb's Third Point, who owned a 9.9% stake in the company, sent a letter in which they announced that they supported a take-private transaction of Soho House, but encouraged the company to find other parties in the hospitality industry that would be interested in paying a higher price as they believed the take private by the company's chairman was too low of a price.
Yeah, rumors about an acquisition of Soho House have been brewing since March 2024, when CC Capital, the investment firm led by former Blackstone executive Chin Chu, was one of the first in line to take the company private, followed by a consortium led by Ron Burkle. At the time, the stock was trading at just in the $5 range.
Months later, we seem to have a conclusion to this deal. MCR, along with its chairman and CEO, Tyler Morse, has agreed to acquire Soho House in a deal valued at $2.7 billion. Shareholders of Soho House will receive $9 per share in cash, a premium of 17.8% from the stock's last close. The spread on the deal is a mere 2.27% at the moment, and the deal is expected to close in the fourth quarter of this year.
It's interesting to see a private club company is also going private. Soho House operates highly exclusive clubs, hotels, restaurants, and other venues focused on the media, arts, and fashion industries. But in recent years, its popularity has waned, and given that the company has constantly struggled with profitability, going private might be the right decision for them. I still remember I had a trip planned to New York City and I was looking for some hotels, and I found Soho House as an option, and it wasn't very expensive, but the reviews discouraged me from staying there.
Interesting. But continuing along with this theme of deals in the works coming to fruition, last week we discussed the TV broadcasting company Sinclair because the company was planning on spinning off its non-broadcasting portfolio, and also because we had seen a series of insider purchases by the chairman of the company. This week, we wanted to discuss consolidation in this little segment of the media industry that had pretty much been given up on by investors as a melting ice cube with restrictions on mergers.
Yeah, when discussing the Sinclair spin-off last week, you had mentioned that the appointment of FCC chairman Brendan Carr, the administration was more open to allowing broadcasting companies to increase market share through acquisitions.
Yeah, exactly. And along those lines, a couple weeks ago, the Wall Street Journal reported that two of the largest broadcasting companies, Nexstar and Tegna, two companies we actually mentioned last week as competitors to Sinclair, those two were likely to merge. The pre-rumor price for Tegna was $15.31, and a deal finally came through last week as an all-cash deal worth $6.2 billion, or a whopping $22 per share. Now, I wonder, was there any money to be made even after the rumor came out?
Yeah, that's one of the things we track because sometimes what happens is when a rumor comes out, the stock moves up very quickly. And so we track to see if you were to buy after the rumor came out and when the merger announcement happened, do you get to still participate in some upside? And in this case, there was 9% of upside left from the point after the rumor came out and the day of announcement of the definitive merger agreement. So the stock was trading at just about $20 when the news came out. The spread on the deal is still 4.36%, but considering that the closing date is likely to be in the second half of 2026, it does not make for an attractive return at this time. Arbitrageurs probably also have some PTSD from Standard General's failed attempt at acquiring Tegna in 2023 for $24 per share. They'd announced the deal in 2022 and abandoned it finally in 2023 when they couldn't get it through.
It was interesting to see that during the standard general deal process, Senator Elizabeth Warren, as is often the case with her, urged the FCC to block the deal. But Senator Ted Cruz wrote to the FCC questioning their lengthy review of the deal, and that lengthy review is what eventually led to its failure.
She always comes out and opposes most of these deals, doesn't she? Especially when it has something to do with consumer goods or media and things like that. At any rate, all eyes are now going to be on the other publicly traded broadcasting companies like Gray Television, Sinclair, and EW Scripps. Both Sinclair and Gray Television generated more revenue than Tegna in 2024, but most of these companies trade at about 6 to 7 times trailing EBITDA, and the forward EBITDA is usually between 8 to 10 because 2025 is a non-election year for them. And as we've discussed in the past, these companies make a lot of their money either in the presidential election cycle or the midterm election cycle. And this is one of those down years for them. And 2026 should see a pick back up in both revenue and earnings.
Hopefully, we start to see a turnaround then. Continuing along with this theme again of deals in the works materializing. One of the bigger deals in the works that we discussed on the podcast was the possible acquisition of Guess by WHP Global, rumors that first emerged in March of this year. WHP Global offered $13 per share for Guess, with two of the co-founders of Guess willing to roll over their shares instead of taking the $13 per share buyout. WHP Global had partnered with Guess in April 2024 to acquire the fashion brand Rag & Bone, so the acquisition seemed likely to go through, especially since there was an existing relationship between the two companies. However, by April 2025, Bloomberg reported that Authentic Brands Group was considering launching a rival takeover bid for the company.
Authentic Brands Group is best known for acquiring many iconic brands such as Reebok, Forever 21, Nautica, Champion, Eddie Bauer, and more. This week, Authentic Brands emerged victorious and agreed to acquire Guess in a deal valued at $1.4 billion, where Guess shareholders will receive $16.75 per share in cash.
The spread on the deal is slightly negative, which is surprising, especially considering that the $16.75 per share bid is significantly higher than the original $13 per share offer by WHP Global, and that Guess was trading at about $13.70 just a week prior.
Let's not forget that the stock had dropped almost, if I recollect correctly, down to the $8 level or the $9 level during the tariff tantrum. And this was when the $13 per share offer was already on the table, and
Mhm.
there had been rumors that there could be a competing offer. So we had it in our model portfolio. We wrote about it as a potential deals in the works that we were interested in. And it was good to see that not only did it finally come to fruition, but it came to fruition at a significantly higher price than we had
Exactly.
originally anticipated. Co-founders Maurice and Paul Marciano and CEO Carlos Alberini appeared to be taking part in this acquisition as well, which was a question we had about the competing Authentic Brands bid in the first place, because we had talked about how they had a relationship with WHP Global, and we were wondering if they would get behind an Authentic Brands bid. Well, the price probably swayed them to participate in this one.
That's what I was thinking as well. Looks like paying up is key, despite the existing relationship between WHP Global and Guess. A higher price seemed to win out at the end of the day. Now, if only that could happen for Dallas News as well.
That would be a good outcome for shareholders. Unfortunately, the way things are going right now, I don't think they are in the best interest of shareholders. Switching gears a little bit, we talked a lot about Zoma Royalty, a company much like Concentra Biosciences that seems to be acquiring zombie biotechs, basically biotechs that are trading below the cash on their balance sheet. Zoma is a biotech royalty aggregator that acquires the economic rights to future milestone and royalty payments associated with partnered pre-commercial clinical candidates. In return, the seller receives non-dilutive funding to advance the internal drug candidates.
This week, Zoma announced yet another acquisition, this time acquiring Mural Oncology for a closing value of $36 million, roughly. Each Mural shareholder will receive about $2 per share in cash, an additional cash amount per share of up to 20 cents.
Yeah, Mural Oncology first started exploring strategic alternatives in April, and the stock was trading at just a little over $1 at that point. The company has a market cap of $36 million and over $70 million of net cash on the balance sheet. So this acquisition goes a long way in freeing up capital for investors and the company itself. I think we talked about how Concentra and Zoma Royalty are essentially shooting fish in the barrel by looking at this lower end of the biotech market and picking up all these cash-rich companies, liquidating them, or spinning off any potentially viable clinical assets.
Exactly. Continuing on, Thoma Bravo, a software-focused PE firm with $184 billion in AUM, is at it again, and this time they are acquiring the software company DayForce for $12.3 billion.
I looked through our M&A database to see how many Thoma Bravo deals I could find over the last 15 years, and they accounted for 35 deals. These are just public deals, and who knows how many more private deals that they have done over the years. I mean, there are probably over 3,000 deals in our database, and it's interesting to see that Thoma Bravo accounts for more than 1% of all deals announced over the last 15 years.
I wonder once Concentra Biosciences is done with its entire run, how much they'll account for if it continues to last.
The difference likely is going to be that Thoma Bravo's deals usually run into the billions of dollars versus Concentra was started out with a few dozen millions and now they've run up into the hundreds of millions, if you will.
Exactly. So if they're acquiring companies at that scale, it makes the Thoma Bravo 35 acquisitions all the more interesting and fascinating. But continuing
Absolutely.
on, DayForce was a rumored deal, and the price before the rumor came out was $52.88. The stock then jumped to $66.62 after the rumor came out, and the final deal price was $70 per share in cash.
DayForce, which oddly enough I had never heard of before this deal was announced, is a human capital management SaaS company, or in simpler words, a HR software company. While Thoma Bravo is paying 6 times sales for the company, the stock is actually down nearly 7% over the last 5 years. And compared to its much larger rival Workday, which was only up 15% over the last 5 years, but was still in the positive territory. For full disclosure, we have a position in Workday.
There's been a lot of talk of AI agents replacing enterprise SaaS software, and this, in some sense, has deflated these SaaS valuations. If you've ever built enterprise software or implemented it, it is hard to imagine AI agents replacing these solutions entirely anytime soon, and this large acquisition by Thoma Bravo lends credence to that theory.
Yeah, I remember a few years ago, everybody was talking about how everything was going to be on the blockchain, and people are thinking of blockchain as a replacement to databases. This whole situation reminds me of something like that. I don't think enterprise software, especially the ones that is very detailed and process oriented, is going to get replaced by AI agents in the next few years. But eventually, maybe AI native companies will gain market share over these kind of companies. Switching gears to stock buyback announcements, Pediatrix Medical Group, a healthcare services firm that focuses on prenatal care, neonatal care, and pediatric specialty care, including pediatric neurology and emergency medicine, announced a $250 million buyback that represented a massive 18% of its market cap at announcement. The company has the clever ticker symbol MD because of its doctors and was previously known as Mednax. I've followed the company for a while and used to have a position in Mednax, or Pediatrix Medical Group as it came to be known later on a few years ago.
The company hasn't done very well recently in terms of revenue growth, but earnings have improved and they have been paying down debt as well. Pediatrics had built their business through a series of roll ups by acquiring medical practices, and this usually leaves these businesses with a lot of debt and in dire straits if the doctors from the acquired practices eventually leave after their contracted period.
Yeah, it's kind of like revenue walking out the door when the doctors who basically pull in all that revenue from patient care decide to leave and either start another practice or go join another clinic. In many ways, this whole situation reminds me of LifeStance, a healthcare services provider that was focused on behavioral health that built itself up through a roll up of psychiatric practices. We're starting to see insider buying at LifeStance, even as the PE firms that had invested in the company are exiting. LifeStance has done a great job over the last year of increasing revenue, reducing debt, and generating positive free cash flow, even though GAAP earnings are still negative. I can see why the insiders of LifeStance are starting to buy stock now. To wrap things up on the stock buyback segment, there are three other buyback announcements that we wanted to briefly mention. Old Republic, which is an insurance company, announced a $750 million buyback that represents 8% of its market cap. They've already been buying back a lot of stock and have retired 18% of the shares outstanding over the last 3 years. The company looks interesting with a low forward PE of under 12 and trading at just 1.5 times tangible book value.
We also saw Sprouts Farmers Market announce a $1 billion buyback, representing about 7% of its market cap at announcement. Sprouts has been buying back stock pretty steadily. They've reduced shares by about 16% over the last 4 years, and the company has been performing quite well too. It's up about 505% over the last 5 years.
They say investing is full of regrets, and Sprouts Farmers Market is one of those regrets for me. I think I looked at the stock when it was trading in the teens or in the 20s, and it went up so much. I passed on it thinking, oh, this is another grocery store company with low margins, but they've executed so well, and it was a missed opportunity for me. Switching to another buyback announcement, DaVita, the kidney dialysis company, announced a massive $2 billion buyback that represented 20% of their market cap at announcement. They've also been cannibals and have repurchased 30% of their stock over the last 4 years.
Moving on to the insider section of this podcast, John Paulson has become somewhat of a constant feature on this podcast and the Insider Weekends articles that I write every weekend. Funnily enough, he's back in an indirect sort of way this week after we saw Julian Baker, the chairman of Madrigal Pharmaceuticals, buy nearly $62 million worth of the company's stock.
Madrigal is John Paulson's largest holding, representing 27.21% of his portfolio as of his latest 13F filing. Felix and Julian Baker, who together make up the prominent biotech hedge fund Baker Brothers Advisors, are also major shareholders of Madrigal, which is their fifth largest position in their portfolio.
The Baker brothers, known for their extreme secrecy, got their start managing healthcare investments for the Tisch family, who transformed the theater chain Lowe's, not the home builder or hardware company, into the massive conglomerate that it is today.
Yeah, I've been following their biotech investments for the better part of a decade at this point. As for Madrigal Pharmaceuticals, it is a biotech company focused on treating metabolic dysfunction associated steatohepatitis, otherwise known as MASH, a progressive liver disease that can lead to cirrhosis, which is permanent scarring of the liver, liver failure, and eventually death.
Founded in 2006, the company achieved a major milestone in 2024 by becoming the first company to receive US FDA approval to treat MASH via its therapy Rezdiffra. Until mid-August 2025, Madrigal enjoyed exclusivity in this market, but on August 15th, the FDA approved Novo Nordisk's GLP-1 drug, Wegovy, typically used for weight loss, to treat MASH as well.
It is worth mentioning that Viking Therapeutics also has a drug in phase 2 trials for MASH, and its readings seem to be better than Madrigal's drug. We have a position in Viking Therapeutics, mostly for its upcoming GLP-1 drug that could potentially get approval, but the MASH drug is also interesting. Getting back to Madrigal, Rezdiffra has beaten sales estimates for 4 quarters in a row, generating revenue of $213 million in the second quarter of 2025. And its commercialization is entirely responsible for turning Madrigal into a rapidly growing company whose losses are reducing over time.
Despite the risk of competition from Wegovy in the US market, Madrigal recently was approved as the first and only medication approved for people living with MASH in the EU. Madrigal expects to launch Rezdiffra in Europe on a country-by-country basis, commencing with Germany in the fourth quarter of 2025.
Yeah, with over 370,000 addressable patients in the European market, a possible expansion in indication for Rezdiffra anticipated in 2027, and the recent acquisition of an oral GLP-1 preclinical candidate, Madrigal is extremely well positioned, and we personally keep an eye on it over the next few months.
We'll wrap up today's podcast with a look at C-suite transitions. 2 weeks ago, we discussed a large acquisition by the cybersecurity firm Palo Alto Networks, where it acquired CyberArk software for $25 billion in a cash plus stock deal. We were reminded of that acquisition when we noticed that Nir Zuk, the founder and CTO of Palo Alto Networks, announced that he is leaving the company.
Yeah, there were a couple of interesting things about that departure, including the fact that it was a sudden departure and that he also stepped down from the board of directors at the same time. This large acquisition of CyberArk is a departure from the previous smaller acquisitions, and I wonder if the departure of Nir Zuk is related to this acquisition.
Yeah, seeing the founder of a massive tech company who's been with the company for quite some time as the CTO leave is quite worrying. But Palo Alto Network's CEO, Nick Arora, has done a great job of leading the company since he came over from SoftBank, where he was the president and COO. The stock is up more than 500% since he joined the company in June 2018.
Yeah, and Nick Arora painted a rosy picture after announcing the acquisition of CyberArk software. He said that this acquisition would allow them to finally solve the identity security market, and they expect to get to $15 billion in annual recurring revenue by 2030. For their last fiscal year, which ended in June 2025, they actually achieved $9.22 billion in revenue.
Finally, solving the identity security issue is quite a big claim, but aren't there quite a few companies trying to solve this very problem?
Yes, indeed, and many different ways. So, for example, there's Okta, which is already an established endpoint security company in the identity space. And then you also have Clear, which was initially focused on airport security and has now expanded to overall identity security. And you also have a company like Red Violet, which we met at the Three Part Advisors conference last year and has done quite well.
The last C-suite transition that we wanted to cover was at Martin Transport, a refrigerated trucking company with a $1 billion market cap.
The company's CEO, Timothy Cole, who has served in his role for 4 years and 4 months, is leaving next month. His replacement is the company's former CEO, Randolph Martin, who served as CEO for over 16 years and was also the son of the founder of the company. So, kind of like those boomerang CEOs that we saw at Starbucks and a bunch of other companies, Bob Iger at Disney, if you will. This seems to be another one of those boomerang CEOs.
From a financial perspective, despite struggles with both the top and bottom line over the last few years under Cole's tenure, Martin Transport managed to have net cash on the balance sheet with very, very limited debt, which is odd for a trucking company as they tend to be somewhat leveraged.
Yeah, they tend to be capex intensive. They tend to have a lot of equipment, and to see a company like that with net cash on the balance sheet indeed is quite surprising. The new CEO transition is actually quite exciting. So hopefully we'll see an inflection in the next few quarters and the company can return to both growth and consistent profitability.
And with that, we will wrap up episode 33 of the Special Situations Report. What we've covered today is just a brief overview of the special situations landscape. So if you'd like to access a more comprehensive weekly overview of all event-driven activity, go ahead and visit our website, thespecialsituationsreport.com. For daily updates and alerts on the special situations world, as well as access to tools to help you identify opportunities, such as the merger arbitrage tool, check out insidearbitrage.com.
And if you enjoyed this podcast, please take a moment to like and subscribe on whatever platform you may be listening on, and especially share it with your friends who are interested in special situations. Thank you.
We also wanted to provide a brief reminder that this podcast is for general informational and educational purposes only. The content does not constitute financial, investment, legal, or tax advice. We do not warrant the completeness or accuracy of the content or data provided in this podcast. Nothing discussed in this podcast should be interpreted as a recommendation to buy, sell, or hold any investment or security. Investing involves substantial risks, including the potential loss of principal. You should conduct your own research and due diligence before making any investment decisions.